Hello, my name is Paul Durrans. I'm one of the investment analysts here at True Potential. Last weekend brought news of trouble from the Middle East as the strategically important Saudi oil processing facility was attacked by drones, putting at risk nearly 5% of the global oil supply. This was allegedly the work of Iranian-backed rebels from neighbouring Yemen. The drone attacks were significant enough to cause a jump in the price of Brent crude oil from $60 to $69 a barrel. This 15% gain represented the largest intraday spike ever recorded. Whilst that figure is noteworthy, it is important to put it into context. Although we are not diminishing the importance of last week's increase, but looking at prices on a historical basis, this level of volatility is a regular feature of oil markets. Prices rise and fall in accordance with the laws of supply and demand, and last week's increase to $69 still puts the oil price some way off previous highs. This should be viewed positively. Significantly higher oil prices causes the rate of inflation to increase due to oil's role as an important input in the production and transportation of goods. In the past, this has led to punishing inflation rates, reducing consumers' ability to spend and restricting economic growth. In the 1973 oil shock is probably the best example of this phenomenon when prices shot up by a staggering 300%. However, a repeat of 1973 is unlikely to occur today. This is because in recent years the world has experienced something of a glut in oil supplies. According to the US Energy Information Agency, oil production has outstripped consumption by around 1 million barrels per day, helping to keep prices low and cushioning the impact of any short-term reduction in supply. This has been helped by the fact sources of oil supply are no longer concentrated in one geographic area. The US shale revolution continues to bear fruit and has elevated the United States to the apex of oil-producing countries. US oil production now accounts for 18% of the global total and has helped reduce prices by preventing traditional oil-producing countries moderating their production in a bid to inflate prices. This has coincided with structural change to global demand for oil. Consumers are becoming increasingly resistant to practices which create environmentally harmful byproducts, especially carbon dioxide. Likewise, government policy is being increasingly crafted to reduce the reliance on fossil fuels for energy and transport needs, with many planning to phase out the production of vehicles powered by diesel and petrol engines. Additionally, the cost of energy generated from renewable technology continues to fall, creating ever greater incentives to pivot away from oil. Taking all these factors into consideration, excess supply is unlikely to abate anytime soon. Even with last week's spike, we are unlikely to see a sustained period of price increases. Saudi efforts to rectify the attack have had a calming effect on the market, with prices already falling back to around $64 in little over a week, boding well for consumers and the wider economy.